start to learn about tax diversification. Okay, so all right, let's look at this. I call it a four phases of wealth, or I could call it four cycles of money. So how is money work with, how is money related to our life? Number one, the very first phase is a contribution. You put money in somewhere, whether it's a real estate, whether it's a savings account, you contribute. And with that contribution, your money is being saved. And the next one is accumulation. Hopefully, the money you put away will gain some form of return, whether it'll be interest rate or investment return. So you want to make sure that it has given you some profit as you put that in there. So if you do the accumulation, so if you on the accumulation side, it could be investment, it could be savings and things like that. So you're letting money grow. Okay. Now, next step is distribution. Now, you're not saving money just to keep it in the financial institution. You're saving money so that you can use it. I call it a distribution. So you can use it for your children's education. You can use it for down payment on your house. You can use it for retirement income, whatever that may be. So there's a distribution of your wealth. And the last phase is transfer of your faith. Whether you can, you can give it away while you're alive, or if you die, someone else will inherit your money, your wealth, whatever you want to call it, right? So those are the four phases of wealth. You put your money in, you let it grow, and you take money out. Whatever is left, you leave it behind. Okay, you give it to somebody voluntarily before you die or after you die. There's some things going on, and the procedure goes, and the money will be transferring its ownership to someone else. So those are the four phases. Okay. So what are the tax benefits on each phases? Ultimate goal is that you want tax benefit on all four phases, but is it possible? No, it is not possible. Okay, so you have to pick and choose which tax benefit you want. But before we do that, we have to look at what are the tax benefit on each basis. So very first one is a contribution. When you put the money in, is it tax deductible contribution? Is it non-tax deductible? What's the tax deduction? So you don't have to pay tax. I mean, if IRA is a good example. If you put $8,000 in, that $8,000 will be deducted from your taxable income. So you'll pay less tax. That's what we call tax deduction or tax deductible contribution. So one of the tax benefit on the contribution side is tax deduction. Accumulation side is it tax deferred growth, meaning that you don't pay tax on the interest or profit. Or if you put the money in a bank, what happened to your interest? You get 1099 at the end of the year, so you have to pay tax on that gain every single year, whether you're spending money or not. So accumulation phase, we're probably looking for tax deferred growth, meaning that you don't pay tax on interest until some distribution phase comes in. Okay. And next one is a distribution. So you have to look at distribution. What is the tax benefit that you're looking for in this distribution? It's a tax-free access. Can you get tax-free access all the time? No, it all depends on what kind of product you have. But once again, I'm just giving you tax benefits on each phases, okay? And the last one is a transfer. So you need to make sure that what would be the best way to minimize tax liability when we're transferring your wealth to someone else, whether that could be uh, gifting your money to somebody, or you die and the money is being transferred to next generation. So these are the things that you have to look into. Do you need to pay income tax? Do we need to pay capital gain tax? Do we need to pay gift and estate tax? So that's something to look into. And there's something else that you need to look into. What is the legal cost? Whether it goes through probates and things like that. And it is a lot more complicated than the other one, because especially when you're dead and the money is being transferred, you're not going to be here to direct how money is going to be handled. So that's something to think about. But once again, those are the benefits that we're looking for. Can we get all benefits all at the same time? No. You have to pick and choose, okay? All right, so let's look at tax efficient products on each phase. On the contribution, if you put a traditional IRAs, then your contribution is tax deductible. If you put your money in qualified plans like a 401k plan, defined benefit plan, cash balance plan, we call it a pension plan, then your contribution is tax deductible. You pay less tax this current year. That's the product. Traditional IRAs and qualified plans. And accumulation side, traditional IRAs, it is built in, not only it is tax deductible, but the growth on traditional IRA is tax deferred. So you don't pay tax on gain every single year, unlike bank. Roth IRAs, even though you don't get tax deduction, but your growth, the profit on the contribution is tax deferred, so you don't have to report the gain. You don't have to pay tax on that gain. Roth IRA is another one that has tax efficiency during the accumulation phase. And qualified plan, pension plan, same way. So that's same as a traditional IRAs. And another one that we also need to look into is a non-qualified annuity. These are the annuities that has no tax code attached to it. It's just like a savings account, but you're saving money through insurance company. So you're putting money in annuities. If it is not a qualified plan, we call it a non-qualified annuity. Non-qualified annuity, you don't pay tax on gain either. So you defer tax on gain. And college savings plan, like educational IRAs, 529 plan, prepaid college plans. These plans, you don't have to pay tax on gain either. Most of these plans are not tax deductible, okay? And distribution side, when you take money out, which are the product that has a high tax efficiency? Roth IRA with a certain condition, 5 years, you opened up your Roth IRA at least 5 years ago, and you're 59 and a half or older, then Roth IRA distribution is income tax free. You don't pay tax on that. Government bond, you don't pay tax on that either, right? College savings plan, if you're using college savings plan for higher education for the beneficiary, you don't pay tax on that distribution. And also life insurance, cash value in life insurance can be accessed as tax-free distribution, okay? So those are the products for distribution. And lastly, transfer Roth IRAs. Since there is no income tax, you don't have to worry about income tax on Roth IRAs, even if it is a transfer. Life insurance, death benefit on life insurance is income tax free, okay? Cost basis, I'm talking about step up in cost basis. You have to look into that also, like house, if you titled it in certain way, you don't have to worry about capital gain tax. because there's what we call step up in cost basis. So those are the things. So you have to look, what is the thing that the client wants? If client wants tax deduction now, use tax deductible contribution, right? If client is worried that he will pay lots of tax when he retire, when he spend money, we focus with tax efficient distribution product. Okay, so hopefully, hopefully these products are familiar to you. If not, hopefully with many trainings, you'll be familiar with this product. Okay. All right. Use of tax efficient product, Roth or traditional IRA. So one of the questions people ask is that I want a Roth IRA. But I always ask this question, do you really need Roth IRA right now? What are you giving up when you do Roth IRA or Roth 401k? You're giving up tax deduction now. And then you're hoping that you don't have to pay tax when you spend money as a retirement. But is it really necessary? Well, one of the things that I look at is a standard deduction. So standard deduction, this is a 2024, married and filing jointly, 29,200, up to 29,200, you don't pay tax on it. Basically, government is saying that, hey, up to that much, you don't have to pay tax. That's standard deduction. So if your retirement income will be from IRAs and there is no other income, if your combined income during your retirement age is less than 29,000, is there benefit of Roth IRA? No, there is no benefit, because traditional IRA, if you use less than 29,000, when combining with other taxable income, then you don't have to pay tax. Even if it is a little over 29,000, your tax bracket will be very low, right? So if you're working, your tax bracket is high because you have a big income. But if you're not working and your income is low, obviously your income tax bracket is low. So do you want to let go of high tax deduction now so that you can enjoy low taxable income later? I mean, you have to make a decision. So that's where the design comes in. That's where the consultation happens. What are you expecting? How much retirement income are you expecting? What are the source of retirement income? Is it taxable? How much is from IRAs or 401k? Something to think about. A lot of time people blindfoldedly think that Roth IRAs is the best thing, but I don't think so. I don't think so. A lot of times Roth IRA is designed for high net worth individual. But irony of thing is that if you're a high income owner, can you open up a Roth? No, you cannot. But you can do Roth 401k without any income limitation. So you can do Roth contribution, or there's a backdoor Roth conversion, meaning that you open up IRA now and later on you convert that IRA into Roth. There is no income limitation on that. You do have to pay tax on that, but that's what it is. You just got tax deduction and you pay tax. So you're hopefully you're netting zero on that. Okay. So that's something to think about. Okay. Another thing to think about is what is the future tax rate? Your individual tax rate, if it is the same as today, will you pay higher tax or lower tax at your retirement age? Or if you're just looking ahead, I mean, that's the trend of tax since what? 1913 to 2020. If you look at it, our income tax bracket isn't that high. Will it stay that low or will it go up? So That's something to think about. If you think that you're gonna face higher income tax bracket at your retirement, then Roth is a way to go, or other tax-free products. Okay, so that's something to think
I
about.
have a question
Yeah,
about the standard deduction. Does that, does our social security benefits include?
you had to look into that. It all depends on how much is a taxable Social
okay.
Security benefit. Okay, and next one, use of a tax efficient product. Now, here's something that is, you really had to look into this. This is one of the reasons why you need to have a tax-free distribution product. Paying tax on withdrawals from IRAs and qualified. Let's say you're taking out $40,000 from your 401k. And that 40,000, is it taxable or non-taxable?
Everything is taxed.
It is taxable. That $40,000 from IRAs or 401k plan is taxable. So if your tax bracket is at 25%, you need $10,000 to pay for that tax on $40,000. Now, where are you going to get that $10,000? If you have no other source, you have to take it out of your 401k again. So if you take out $10,000 from 401k plan, is that 10,000 taxable or not? Yes, it is taxable. So you took out money to pay tax, but it becomes double tax.
Sure.
How do you manage that? Okay.
Take money out of the non-tax.
So I think it is good idea to pay tax with the tax-free plans, like the Roth, like IULs, like whole life. So if you at least the tax portion, you don't have to worry about paying tax on tax, right? That's literally what's happening. So is there one product or plan that fits every single need? No, but you need to have a diversification. And one of the diversification that we're talking about is a tax diversification. So if you have a taxable account, and if you have a non-taxable account, at least you have a choice. Something to think about. Asset planning. So if you don't spend all your retirement plan in your lifetime, like 401k plans or whatever, okay? Okay, if you don't spend all your let's say you have $1 million in 401k, you only get to use 700,000, and your 300,000 is gonna be taxable. What kind of tax? Income tax. How about estate tax? There may be an estate tax. Yeah, as of right now, is more than $10,000.
No,
It's
it's 5 mil.
5 mil, is it? No?
No, it's the,
Exclusion is at the 5 mil?
it used to be 13 point some million.
Now it's a 5 mil.
Yeah.
So if your asset is below 5 mil, you don't have to worry about estate tax. But if your total asset, the total estate you're leaving behind is more than 5 million, we're looking at another 40% tax bracket. So if you look at this retirement plan, if you're a high net worth person, here you are also looking at double taxation. It is subject to income tax. It is also subject to estate tax. Or if you're giving it away. I mean, estate tax and gift tax is the same thing. Only difference is whether the giver is alive or dead. Tax bracket is the same. Okay? And whether it is a capital gain tax or not. So most likely, if it is a financial product, more than likely you don't have to worry about capital gain tax. All right? So there are so many taxes. And you also need to look into step up in cost basis. So a lot of times, some of the assets are their cost basis goes up at the time of death. So you don't have to worry about capital gain tax. So you have to look into this also. But that's not true with a retirement plan. So if you ask me, what's the very first account to use up when you have many different tax efficient product during retirement? I always been telling people to use your qualified plan, IRAs and qualified plan first. Because if you're, that's a worst account to leave it behind when you're passing away. It is subject to income tax, it is subject to estate tax, depending on your estate. Okay, so something to think about. Okay. Is there other tax-free access products? The first one is a college savings. There are many different college savings, and I don't want to dig deep into this product because most of you do not have a security license to do the college savings. But if you do, college savings product can be accessed tax-free if it is being used for higher education. Okay, that's one product that allows tax-free access. Long-term care annuity. So if you have $100,000 and $50,000 is a cost basis, and when you're using it, that $50,000 is taxable, right? It's a LIFO, also last in, first out. You have to pay tax on $50,000 first, right? But what if you 1035 that non-qualified annuity into annuity that has a long-term care rider on it? As of current tax law, long-term care expense paid by this annuity is not taxable. Can you use this with a qualified plan? No, not in California. Okay, but that's something to think about. If your family history has some you're at the high risk of getting a long-term care, that's something to think about. Or get a life insurance with a living benefit. Okay. So as you can see, there are many things to consider, and that is, I hope that today's training was something that you know already. If not, hopefully many meeting together with me and other agents, you get familiar with all this tax aspects. So I've been talking about product all the time, so I thought that this would be a good time to just give a pause on the product and let's talk about different tax efficiency. Okay. All right, that's the end of today's slide. So if you have any question, yeah, that was fast. And those of you who are not seeing me now, I took a shingle shot yesterday. I'm kind of half out. I'm not in my normal self. I have body ache.
Simon is high.
I have a body ache all over the place. I got
Oh, no.
tetanus shot and the shingle shot yesterday
At the same time.
at the same time. So I couldn't sleep last night with the pain, but I think I'm getting better. I think your company makes it better. All right. Any question? Bianca, any question?
One.
No, no questions.
All right. Dana, any question? All right. Joanne?
No question. Just can I get the record file?
Yeah, I'm having my son doing this, doing some video editing, and once it is ready, I'll post it on the YouTube.
Okay,
And
thank
I'll
you.
let you guys have that link.
I can get the slides.
Yeah, I can send you the PowerPoint if you want. All right, guys. I don't think you'll mind.
Down my mic. Thank you, Simon.
All right, Dana.
Sorry, thank you.
All righty. Okay. Thank you.
Okay, thank you.
And hopefully you can come in and see me on face to face.
Yeah.
All right.
Okay.
Thank you,
Thank you.
everyone.
Thank you.